The crypto market is witnessing heightened volatility, and with Bitcoin reacting to the ETF driven institutional flows and Ethereum underperforming amidst the shifting capital rotation. We will break down the key technical levels traders are watching and where the smart money is moving within the Web3, from AI agents to the real world assets, and whether privacy coins can stage a comeback in the next cycle. Joining us to decode these trends is Jason Fernandes, co founder at AdLunam Inc. Jason, welcome on 3.0 TV.
Thank you so much for having me.
So let's begin with let's understand, since we're talking about the largest cryptocurrency, which Bitcoin has seen recent sharp volatility with ETF-driven flows changing demand dynamics. How do you read the institutional positioning in Bitcoin right now, or do you have a different method?
Yeah, so you're right. The ETF complex has sort of turned Bitcoin into a flow market. So you can see prices look irrational on the surface, mostly because it's driven by allocation decisions by funds, rebalancing, basis trades, risk parity style de-risking. What I really watch for is whether dips are being bought with like spot absorption, right? Is the spot retail market actually picking up these dips, or is it just sort of leverage bounce? So whether it's bots or things like that. Even bots, I guess one could consider retail trading, but is it somebody who is sort of betting on Bitcoin to do a certain thing in the future? So is it like just somebody playing leverage? So I think that's sort of the main thing that I look at. And when ETF inflows return quickly after you have sort of a risk-off day, that's when you know there's real positioning. So I think Bitcoin is trading less like a narrative and more sort of like an infrastructural plumbing system where you have flows, fourth rebalancing on one side, and it's sort of that's more important than opinions and narratives.
So let's understand more about the second largest crypto, which is Ethereum, that has underperformed Bitcoin in recent months, Jason. And is this simply capital rotation, or is this the market reassessing Ethereum's monetary premium thesis?
So I think it's a bit of both. Some of it is sort of basic rotation. Bitcoin is right now the cleanest institutional exposure that sort of large institutions can have to the digital asset market, and it benefits first when it's more traditional allocators step in. The deeper issue is whether it's sort of how the market constantly stress tests Ethereum's monetary premium against this reality. So the issuance dynamics, the fee burn consistency, roll-up centric economics, and whether the value accrues to Ethereum or does it fragment across the layer two? So for example, you have so many apps and dApps, things like that built on Ethereum. Does the value sort of stop there? Because those guys have their own token. Does the value stop there, or does it sort of bleed into Ethereum? So I think that Ethereum can still sort of win the long game because it's still a settlement layer for a large chunk of on-chain activity. But in the near term, it needs a demand catalyst. Like what we're seeing right now is massive loss of retail interest in crypto, and so that obviously bleeds into Ethereum. So since you have so many of these tokens that are sort of built on Ethereum, that bleeds over to Ethereum. So I don't think that it's like Ethereum is broken per se. Its value capture is being audited sort of in real time.
So Jensen, there was an event that happened in October 10th. 2025 of the $19 billion liquidity that was drained out from the markets. And since then, the Bitcoin is corrected roughly around 50%. And we are looking at close to around $63,000 to $65,000 levels as we speak. So on technical charts, Bitcoin is respecting key support zones. What are the most important levels traders should watch in the near term, and the most important thing for the traders as well?
So I think some of the sort of prices you want to look out for is January's 2026 swing low. So that was about 58K to 60K. And then, you want to see maybe, and that's sort of where, a lot of buyers previously absorbed a lot of the sell pressure. You also kind of want to look out for 67 to around like 69. That was a prior consolidation range and sort of failed breakout zone. And then 72 to 74K, that was the most recent sort of lower high rejection zone. That's like it was not able to go past that. But that is, you asked specifically technical, but I want to caveat those numbers because so much is dependent on sort of macroeconomic factors, how essentially Bitcoin behaves as a risk asset, right? And so when money gets scarce, when the flow of money is sort of is stopped by these interest rates, and by the way, the interest rates are such because the Fed is concerned of there might be a recession or there might be higher inflation, and that's a real concern when you look at sort of the political instability all around the world, right? So the Fed is trying to position like the United States in such a way that they're able to absorb some sort of a black swan event, or even something maybe less, like let's say a war with a major Middle Eastern country. So the Fed is trying to position the country in such a way that it's able to absorb that, and so therefore they're keeping interest rates where they are. But the effect of that is, as long as that stays the case, you're going to see a massive drain away from sort of risk assets like Bitcoin and into sort of much more safe, sort of traditionally safe assets. It's essentially going to have capital rotation on a very large scale. So I think I want to preface those numbers because so much depends on how the market sort of shapes out in relation to the political situation. I mentioned in a sort of bad situation you could see even 40 to 50K, although I don't think that's currently the way things are going. That doesn't seem likely, but those things can change if there's a war, oil prices rise and things like that.
So Jason, very quickly, one question. If you were allocating fresh capital today, what percentage would you deploy in Bitcoin? Ethereum, is it going to be Ethereum, early stage Web3 ventures, or cash or stable coins? Very quickly.
Sure, absolutely. So this is not financial advice, but just sort of how I'd frame the risk managed allocation. So I would say around 45% to Bitcoin, because Bitcoin is volatile enough that you could still profit from it without necessarily having to expose yourself to Ethereum and then even sort of early stage ventures. But it's also good to sort of have that in your portfolio. So then I would say sort of Ethereum at 20, early stage Web3 ventures somewhere around 15% is what I would say. That would be IDOs and things like that. But of course you have to be extremely careful. That's something that I think I would definitely do due diligence on that. Check which launchpad they're launching on, because of course that like how prestigious a launchpad is tells you a lot about the due diligence that they've done in terms of presenting that project to their community. And then finally, the last would be like a 20% in stablecoins or cash, because obviously cash is king, and then stablecoins also have the ability to earn yield. So while Bitcoin remains the cleanest sort of macro ETF flow beneficiary, I think like Ethereum is a strategic bet when it comes to settlements, on-chain activity, and early stages when you have these asymmetrical upside levels. But position sizing is everything, and stables provide that optional that liquidity that you need during the volatility.
Thank you so much for being part of this special show on Trader.tv. Thank you once again.
Thanks so much. Appreciate that. Have a great day.